Yes, so what I was saying was financial statements tell a story, but they also can be used to focus the future and future or performance or value of the company. Now, there are several types of financial ratios that you can generate. So one of those are to do with profitability. Now, profitability ratios are mainly of concern to investors. Investors are not worried about the cash flow on a daily basis. What they are more worried about is whether at the end of the year, the company will declare a profit or a loss. So these investors, for example, unlike suppliers or customers or banks, customers, suppliers, banks, and they are more interested with cash flows. Investors are more interested with profitability at the end of the year or at the end of the financial year. Now, one such profitability ratio is what is called return on equity. Return on equity. The other one is return on invested capital. So if you bought shares, you want to see what is the return on your shares. What is the return on equity? Or what is the return on the invested capital? So you will need to calculate what these ratios are showing. Okay? So the return on equity is calculated by taking two, remember, financial ratios are a relationship between two or more records or numbers in the financial statements, the relationship. So now the return on equity must be a relationship between what? It is a relationship between net income and average shareholders' equity. So the way you calculate it is that you take the figure you can find from these financial statements, like net income, for example. You divide it by average shareholders' equity. That will give you what the return on equity is. So the return on equity is equal to net income divided by average shareholders' equity. Now, average shareholders' equity will be found in the balance sheet. And how do you find the average shareholders' equity? Average shareholders' equity, what you do is you take the beginning or opening balance plus the closing balance divided by 2. So you take the opening balance of shareholders' equity plus the closing balance of shareholders' equity, which means you have to use balance sheets of 2 years. You see the closing balance of 2022 and see the closing balance, because the closing balance of 2022 will be the opening balance of 2023. And then you see the closing balance of 2023 divided by 2. So you add the 2, divide by 2. You add the 2 numbers because you are looking for average. Once you add 2 numbers, that average has to be divided by 2. And net income, you can find it in the income statement. Okay? Then you will have calculated return on equity. That represents the profitability in terms of your return on equity. The other one is called the return on invested capital. And the return on invested capital is represented by net operating profit after tax. You compare that with your average invested capital. So the return on invested capital is equal to NOPAT, which is net operating profit after tax. That's NOPAT. Divide that by average invested capital. Average invested capital, you find it in the same way, the same way we calculate, we found average shareholder equity. You just do the averages of the 2 opening and closing balances. Now, these are not the only, they are not the only profitability ratios you can find for investors. There are many others. So for example, I want to ask you a question. Company A makes sales of 100 million and declare a profit of 50 million. Company A makes sales or turnovers, sales volume of 100 million. And at the end of the year, it declares a profit of 50 million. Company B makes sales volumes of 500 million. And at the end of the year, it declares a profit of 100 million. Sales volume of 500 million, profit is 100. Another company, sales volume of 100 million, profit 50. Which of the 2 companies is more profitable? Mona and Justin.
Company A.
Company A. Why? What have you done there?
Company A.
Sir, may you repeat on company A?
Sorry?
May you please repeat on company A?
Company B.
A.
Let me repeat everything. Company 1, company A makes sales volume in a year of 100 million. and declares a profit of 50 million. Company
Okay.
B makes sales volumes of 500 million and declares profit of 100 million. Which company is more profitable? If you are an investor, in which company will you buy shares?
Company A.
Company A.
Yeah.
Why?
Because that 50 million is the 50% of the sales. That means profit was 50% of what they invested.
So there, those figures do
But
not.
company B,
Yes, Justin, you want to speak?
No, no, it's a company A because my sales are low, but our profit is high.
Okay. Now,
Mm.
in most cases, in this particular case, you as guys who are doing corporate financing, what you will be thinking about here is you have to calculate some ratios here. So what kind of ratio are you going to calculate? Because these numbers are not giving you any ratio. What story are they saying? So you have to calculate some ratios which will tell a story. So if a company's sales volume per year is 100 million and it's declaring profit of 50, another company's volumes are 500 million and it declares a profit of 100. From a layman's point of view, you cannot say the company that is has made 100 million has made more profit than the company that has only made 50 million, because the sizes are not the same of volumes. Now, in order for you to be justified, you need to calculate some ratios. So the ratio you'll be calculating is income, net income, which is your profit. Because profit or income is not the same as sales revenue. No, when you go to the income statement, you will see that it says sales revenue, and then another item in the income statement says cost of sales, then you have gross profit, and then you have depreciation, blah, 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 then, tax, and then you have net profit. So which tells you that sales volumes are not what the company is making. The sales volume do not represent money, do not represent income to the company. So in this case, what we have to do is we have to take sales, we have to take this profit, which is the income, divided by sales or turnover, and find a financial ratio there. So if you say 50 divided by 100, what ratio do you get? 0.5, right? Right?
Yeah.
Justin Mona.
Yes, yeah.
Yes, 50 divided by 100 for company A. For company B, you take 100 divided by 500. That gives you 0.2. Right?
Yes.
So company A has a financial ratio of 0.5. Company B has a financial ratio of 0.2. So 0.5 is far much greater than 0.2. So company A takes less effort to make a profit, doesn't struggle to declare profit. So please know that when you are asked such questions in an exam, just fight professionally. Don't just say, okay, but give some, make some convincing calculations. This and what do these financial, what story? So the story here is that company A doesn't struggle as much as company B to make a profit. Which means if the environmental conditions, if the economic conditions become bad, it is very likely that company A will be able to declare a profit than company B. Should there be some decreases in demand, for example, should there be some adverse economic variables in the economy, company A is very likely to be able to declare some kind of profit area or better than company B. So you use your economic background, your financial background, your corporate financing background to make some decisions, to develop a story. Because I just told you that financial ratios tell a story. And they can be used to predict the future. Okay? Now, these profitability ratios are many. Just now, we have just looked at a profitability which deals with income versus sales volumes. You can calculate a profitability ratio there. Just as a return on equity, a return on invested capital, and blah, blah, blah. There are many. So as you noted when you are writing your assignments, these financial ratios are so many that I'm sure you even had problems in deciding which ones to talk about in your assignment. Because you can play around with these numbers you find in these financial statements, whether it's in the balance sheet, income statement, or statement of cash flow. You can find so many. You can develop or calculate relationship between so many of those numbers and derive what you want to use for decision making. As I said, there are so many of those stakeholders that we discussed: investors, bankers, suppliers, customers, competitors, MRA, what else did we discuss? Competitors, MRA, and trade union representatives, and all that list. So these ratios, each one of these people, of these stakeholders, they can go into these financial statements, calculate something that they can use for decision making. Now, there is also another guy who did a lot of these calculations and financial analyses, and which is called the DuPont analysis. We will not go into that one. but it's just a variation of this thing about playing around with the figures in the financial statements. There are so many of these figures where you can calculate whatever you want. Okay. When you go into these books, you will see, I'm sure you saw when you are doing your assignments, that there are so many that you can calculate, depending on what you need to, what story you need to tell. Okay. Now, another financial analysis or some common financial analysis to do with their bankers. Because the reason I'm saying that when you are doing this financial analysis in corporate financing, you cannot forget, one, the equity part of it, and two, the debt part of it. Why? We learned that corporate financing or sources of funding for corporates, financing of businesses is in two forms, is in two major forms, equity or debt. So when you are doing these financial analyses, financial ratios, don't forget to talk about the ratios that deal with the investors, which is equity. And then the ratios that deal with debt, people who lend you money. Now on debt, the major ones, there are also many on what banks look at, for example. But remember, debt is not only for loans. Debt can also be in form of accounts payable. You remember on the balance sheet, you have on the left-hand side where you have assets, you have what we call accounts receivable, meaning you supplied something and they have not paid you back. They have not paid you yet. And then on the liability side, on the right-hand side, you have the liabilities. On the balance sheet, you have an item there which says accounts payable, meaning suppliers, those who gave you things you have not yet paid them. So whenever you have got something on credit, you have not yet paid, that is also debt, because you need to honor that payment. You need to honor that. So apart from paying for loans, you also have other obligations that you have to pay. Time flies fast, eh? Already we have less than 10 minutes. Ash. Okay, we'll finish before this 10 minutes goes. So two of the most common debt ratios are, one, what we call current ratio. So current ratio is basically is equal to current assets divided by current liabilities. It's a debt, it's a debt sustainability ratio, meaning it's something that tells you whether a company can pay you if you lend them money or not. So it is called a current ratio, and this current ratio is calculated by or is equal to current assets divided by current liabilities. Basically, are you able to convert these current assets into cash and pay somebody you owe money to? Is it a loan or a supplier? So this current ratio is a financial ratio, which a supplier might want to calculate or a banker might want to calculate on you as a business. Now, current assets are encompassing a lot of things. It's not just, it's cash plus other things. Current assets are composed of cash, accounts receivables, sometimes inventory and things like that. Because the idea is that you might be able to convert that into liquidity. So can you be able to pay your liabilities with these current assets? Now, some lenders or suppliers will not want to include all these accounts, receivables and blah, blah, because they are not so sure. They want their money very quick. So they will rather calculate a ratio, which is called a quick ratio, not just a current ratio. Now, a quick ratio is about whether this company can pay you quickly. So if you supply something, within 10 days, they will pay you, or within a month, they will pay you, you know? Current assets as such, current ratios cannot give you that kind of picture. So you want to calculate what is called a quick ratio. Sometimes some people say it's what they call it an acid test. So quick ratio, you only look at cash divided by current liabilities. So then you get a quick ratio. That one gives you a stronger belief that the company can pay you money on quick notice. Okay, so that one is quick ratio is calculated as equal to highly liquid assets, which is cash, basically. So in other books, you just find it written cash divided by current liabilities. Here, we have it as highly liquid assets, which basically is cash. So there are many of these things that you can do and get what you want. Then there are also ratios that, apart from these two, equity and debt. On equity, there are many ratios. On debt, there are many ratios you can calculate. A variety of ratios. There are also some ratios which are to do with risk. So financial risk ratios are also many, but some of them are, for example, you take interest-bearing debt. Not all debt has got interest, remember. Some of the bonds, the interest is, no, some of the debentures, the interest is not like loan, like a loan. So what you do is you take interest-bearing debts, divide them by shareholders' equity. That represents a risk that you, this company you are investing money in has. So these two relates to investors who are taking a risk. So apart from the return on equity, the return on invested capital, you can also calculate some risks that are involved, for example. Another one is, for example, you can calculate operating income divided by interest payable. So what is the income that you are making, and what are the interest expenses on your debt? Because if the interest expenses on your debt are too much, it means you are a risk. So you can go on and on and on and on and on. These ratios are many. So in the exam, I may just ask you to choose whatever, or I may give you something and you explain. But we'll discuss that on Thursday when we have when we tackle the areas of study. But ratios are quite many. But what is important for you and me is to look at the categories. So profitability, risk, and then you have liquidity, meaning whether you can pay back your debts. So far, are you having any questions before we close?
No, sir.
Okay, sir.
Good. Mona and Justin, don't be surprised when you pass well, because you are a committed student.
Thank
Okay.
you.
Yes, God rewards people who work hard, who are determined. So by attending a
Thank
class,
you.
it just shows how serious you are about your studies. Thank you so much.
Thank you,
You're
sir.
welcome. Thank
Yeah.
you.
Good. Have a great day.
You too.
I'll ask Ujeni go ku WhatsApp kwa Tugo if we can meet on Thursday. I don't know. Maybe I should ask you too. What time is better for you on Thursday? So we can have areas of
8.
study session
8 to 10, sir.
in the morning.
Yeah.
Is that not too early, my dear brothers? Come on.
Oh no, we can start at 9:30.
No, it should be later. What about in the afternoon?
In the afternoon.
Yeah, or 6 or 7 p.m. or 8 p.m., something like that.
Oh,
Okay.
When you are in your bed or when you have eaten and relaxing on whatever. So
Yeah,
choose a
it's
okay,
time,
fine.
choose a time between 6
maybe after
and 9. Sorry?
7:30 from 7:30.
Is that okay with you, Justin?
Yes, it's fine.
Okay. So 7:30, I will send that on the WhatsApp group to say we are meeting again on Thursday,
Okay.
7:30.
Okay, okay.
Yeah, bye for now.
Bye.
Bye.